Hi there. Welcome to Share Click, where science meets investments, and I'm your host, Raj. Friends, this could probably be my most significant editorial for the weekend this year. I think while everybody's arguing whether they are headed for recession or a boom, the real story is being written in places most people never look. A $234 billion digital currency market is quietly becoming one of the biggest buyers of US debt. Trade policies are reshaping global supply chains worth trillions, and the Federal Reserve is trapped between inflation fears and recession fears. The next 12 months will determine America's economic future. Here's what we guys need to know to position ourselves for what is coming. Let me walk you through what I think is really going on with the US economy right now. Over the last weeks, I have dug deep into data across 10 key areas, and the picture that emerges is both fascinating and concerning. Think of this as our guide to understanding the economic crossroads America finds itself in 2025. And this is going to be slightly long, but there's plenty of stuff you would get that can help you become a better investor the rest of the year. Here's the thing that jumps out immediately. We are living through one of the most uncertain economic periods in recent memory. The economy is showing remarkable resilience in some areas while flashing serious warning signs in others. It's like watching a skilled driver navigate a winding mountain road in heavy fog. They are managing to stay on track for now, but the visibility is terrible and the risks are real. That's the graphic image that I would like to give you to explain what I'm seeing. Let's start with how Uncle Sam is funding itself, because this affects everything else. The Treasury is still borrowing massive amounts. We are talking about 514 billion in the second quarter of 2025 alone, with another 554 billion projected for the third quarter. Now, here's where it gets very interesting. The bond market is acting really weird right now. Normally, when things get scary in the world, investors run to US Treasury bonds like they are the ultimate safe haven. But that's not happening anymore. In April 2025, we saw something most unprecedented. Stocks fell, and bonds also fell, and the dollar also fell, all at the same time. That's like your umbrella, raincoat, and shelter all failing during the storm. The Treasury Borrowing Advisory Committee. Think of them as the wise elders who advise on government borrowing. They are genuinely worried. They are seeing extreme volatility where bond prices swing wildly during the day, even when they end up roughly where they started. It's creating what they call a risk premium, which is basically investors saying we want extra compensation for the uncertainty of holding US debt. Here's some good news. Banks seem to be handling the current stress reasonably well. The banking system has what's called abundant reserves, which basically means they have plenty of cash to cushion or absorb shock. During the April market chaos, the funding markets where banks and others borrow money overnight stayed remarkably stable. That's actually a big deal and suggests the financial plumbing is working even when everything else is shaky. This one's fascinating, and most people aren't paying attention to it. Stablecoins. Those digital currencies pegged to the dollar. They now represent a 234 billion market. Here's the kicker. About half of that money is invested in treasury bills. That's roughly 117 billion in steady demand for government debt. But get this, experts think this market could grow to 2 trillion by 2028. If that happens, stablecoins could become one of the biggest buyers of US government debt. It's like having a new massive institutional investor that most people have never heard of. The catch? Well, nobody's quite sure how to regulate this properly yet. The job market looks pretty good if you just glance at the headlines. Unemployment is sitting at 4.2%, which is historically very low. The economy added 671,000 jobs in the first 5 months of 2025. Sounds great, right? But dig a little deeper and you see something concerning. Federal government has been shedding jobs since January. Companies are announcing more layoffs than usual. And perhaps the most telling, the rate at which companies are actually hiring new people has been below normal since late 2023. It's like businesses playing it safe. They're not firing people en masse, but they're also not eager to hire. The labor force participation rate is basically how many working age people are actually working or looking for work is defined. It has been declining. It's now at its lowest level since December 2022. That's not necessarily bad if it's just because baby boomers are retiring, but it could be also a signal of people getting discouraged and giving up on finding work. Here's where the resilience story really shows up. After the economy actually shrank by 0.5% in the first quarter of 2025, which had everyone nervous, it came roaring back with a 2.3% growth in the second quarter. That's actually pretty impressive and shows the underlying strength of the American economy. But here's the thing, this recovery is happening despite and not because of current trade policies. The trade tariffs that have been implemented are starting to bite. We are seeing the average tariff rate jump from about 2.5% to 14.5. This might not sound like much, but it's huge in economic terms. Think of it this way. Imagine if someone suddenly told you that everything you buy from certain stores now costs 15% more. You'd probably buy less of the stuff, right? That's what is happening to the economy as a whole. The Congressional Budget Office expects imports to fall over 7% in 2026 and even exports to decline as American companies become less competitive globally. This is where things get really concerning. The federal debt, the gap between what the government spends and what it brings in, is running at 6.4% of GDP in 2025. And it's expected to hit around 6.5% in 2026. To put that in perspective, everything above 3% starts to make economists nervous about long term stability. But it gets worse. Interest rates are much higher than they were a few years ago, which means the government is paying more to borrow money. The 10-year Treasury yield is sitting at 4.5% compared to near zero just a few years back. It's like having your mortgage rate jump suddenly from 3% to 4.5%, except the mortgage is for trillions of dollars. And here's the really scary part. Bond investors are starting to question whether there's a credible path to getting the deficit under control over the medium term. When your creditors start getting nervous, that's never a good sign. And I think the federal government has been borrowing using short term debt and avoiding issuing longer term bonds. And this can go on for a particular period of time, a little period of time, but somewhere around the line, they will have to refinance long term debts that are coming due. The current administration is betting big on tariffs, essentially tariffs on imported goods. The numbers are eye-popping. They are projected to bring in 2.5 trillion over the next decade. That's real money that could help with the deficit. But here's the catch. Tariffs are essentially a tax that gets passed on to consumers. Remember, when gas prices went up and everybody felt it, tariffs work similarly, except they affect the price of a ton of goods. We're already seeing inflation expectations spike. The University of Michigan survey shows people expect prices to rise 5.1% over the next year, up from 3.3% in January. The economic theory here is that higher tariffs will force companies to reshore, bring production back to America. That could work in the long run, but in the short run, it's mostly just making things more expensive while American companies scramble to find alternatives to the suppliers they have relied on for years. Consumer sentiment, that is, how people feel about the economy, fell 18% between December 2024 and June 2025. That's a massive drop. People are worried, even though many economic indicators look okay on the surface. This matters because consumer spending drives about 70% of the US economy. If people feel nervous and start spending less, that can become a self fulfilling prophecy where the economy actually does get worse. Speaking of the Fed, they are trying to walk an incredibly fine line right now. They cut interest rates by a full percentage point in the second half of 2024, but then they hit the pause button. They are basically saying, we want to help the economy, but we need to see what all these policy changes do to the inflation first. The market is expecting about 0.9 percentage points of rate cuts this year. But Fed officials seem more cautious. It's like they are playing chess while everyone wants them to play checkers. They are thinking several moves ahead about the consequences of their actions. And this is where the on again, off again, and varying tariff pronunciations by the White House makes it difficult for the Fed. Here's something that might surprise you. Federal government employment has been declining since January 2025. That's unusual for a new administration, but it reflects a deliberate effort to reduce the size of government. At the same time, Congress passed something called One Big Beautiful Act in July 2025. Yes, that's really what they named it. This extends tax cut that were set to expire and adds new ones, like eliminating taxes on overtime and tipped income. The Congressional Budget Office estimates this will add 2.4 trillion to the deficit over 10 years. So we have a situation where the government is trying to spend less on operations, but also collecting less in taxes. Whether this math works out depends largely on whether the economic growth from lower taxes exceeds the cost of reduced revenue. What could go right? Let's talk about the optimistic scenario first. If ongoing trade negotiation succeeds in reducing tariffs from their current peaks, that is, all countries drop their tariffs in a reciprocal basis, then inflation pressures could ease quickly. This would allow the Fed to cut rates more aggressively, supporting economic growth. There are also signs that business investment could pick up significantly. The tax bill includes provisions that make it more attractive for companies to invest in new equipment and facilities. If that happens, we could see a productivity boom that helps the economy grow faster while keeping inflation in check. The stablecoin phenomenon could be a real positive. Having a growing source of steady demand for treasury securities could help keep borrowing costs manageable even as debt levels rise. Now let us look at what could go wrong. The downside scenario is genuinely scary. If bond investors lose confidence in America's ability to manage its debt, interest rates could spike dramatically. We are talking about 10-year Treasury yields potentially jumping above 5%, which would make everything more expensive for everyone, from mortgages to business loans to borrowing costs. This could force what economists call an austerity trap, where the government has to cut spending and raise taxes dramatically just to convince bond investors it's serious about getting debt under control. That would likely trigger a recession. Then there's also the risk of a full-blown trade war. Several court cases are challenging the legal authority to impose the current tariffs. If those succeed, it could either force tariff removal, creating some kind of a policy chaos, or prompt the use of other legal authorities to keep the tariffs in place. This could end up creating constitutional conflicts. Then there's also the possibility that as US raises the tariffs, other countries might also raise tariffs, and this could reduce the global trade and also start having an impact on the GDP and shrinking it. There could be a fallout where countries that are dealing with the US might look at the service sector where US has got a trade surplus and start imposing tariffs or something like tariffs on the service side. That could impact the MAG 7. So those are the things that we need to consider. Now, let's take a look at the global context. Here's something that doesn't make headlines but should. Other countries are starting to question America's role as the world's financial safe haven. When US Treasury bonds fell alongside stocks and dollars in April, it suggested that the international investors might be rethinking their automatic assumption that American assets are the safest place to park money during uncertain times. This matters because America has benefited enormously from what economists call exorbitant privilege. The ability to borrow in our own currency and have the whole world want to hold our debt. If that starts to change, it could make everything much more expensive for Americans. Here are the key things to keep an eye on. inflation expectations. If surveys keep showing that people expect higher inflation, that could become a self-fulfilling prophecy as businesses raise prices preemptively. Then you look at the dollar. If the US dollar continues to weaken during times of stress, it suggests a fundamental shift in how the world views American assets. The job market softening. Watch for unemployment claims and job cut announcement. The labor market has been the economy's strongest pillar, and if it starts to crack, everything else could follow. Watch the bond yields. If 10-year Treasury yields jump above 5%, it could signal that investors are demanding much higher compensation for the risk of lending to the US government. Look for trade policy clarity. The ongoing court cases and trade negotiations will determine whether tariff uncertainty gets resolved or becomes worse. Well, the bottom line is that we are flying through turbulence. Here's my honest assessment. The American economy is remarkably resilient and has shown an impressive ability to adapt to massive policy changes, massive doses of uncertainty. The recovery from the first quarter contraction was swift and strong. Employment remains solid and household wealth continues to grow. But we are also living through a period of extraordinary uncertainty that is creating real costs. The questioning of America's safe haven status, the spike in inflation expectations, and the unsustainable fiscal trajectory are all serious concerns that cannot be ignored. The most likely outcome is that we muddle through. Growth stays positive but modest. Inflation remains elevated but manageable, and financial markets stay volatile but functional. Think of it as an economic turbulence that's uncomfortable but not catastrophic. However, the risks of something worse are higher than usual. The combination of fiscal pressure, policy uncertainty, and changing global dynamics creates the potential for more serious problems if things start to go wrong. The key question is whether policymakers can provide enough clarity and stability to allow the economy's underlying strength to shine through, or whether the uncertainty and policy conflicts will eventually overwhelm the resilience. And right now, it honestly could go either way. What I can say with confidence is that we are living through a genuinely historic moment in American economic policy. And the decisions made in the next 12 months will likely determine the economic landscape for years to come. Buckle up. It's going to be an interesting ride. Friends, your support and patience has enabled me improve as a content creator, and you have become my community. I want to hear from you. After listening to my editorial, what do you think of the markets and where do you think are the opportunities for us? Please put that in the comment section. Please press like and subscribe if you have not yet subscribed. It will help build up our community and our channel. Thanks and have a great day. I'll catch up with you in the live stream Monday morning at 7:45 a.m. Eastern Time. Bye for now.